Thank you for joining us for Tax Summit Week 2021. Our second session for today is Selling Your Business in a Time of Growth, Uncertainty, and Change. At this time, I'm pleased to turn our call over to Andy Swanson. Andy?
Thank you. To start out with here today, I want to quickly introduce ourselves. We've got three people on the line here. Myself, I'm Andy Swanson. I'm a partner in our Washington National Tax Group and also head our private business practice here at RSM. So I'm joined today by Jennifer Wiskus, who's also a partner in our M&A practice located in San Francisco. And we both have the joy of being joined by Stephen Faulkner, who is the head of private business advisory with JP Morgan out of Columbus, Ohio. So hopefully we can bring you some insights here today. Our agenda, first off, what we decided was to take a little bit different approach today, kind of focusing on four topics and dealing with what are the top 5 items that we think people should be aware of within those areas. So first off, we're going to talk a little bit about what does the M&A market look like today. SPACs were a huge thing in early 2021 and 2020, so we want to cover a little bit about what business owners should be thinking about with regard to SPACs. Thirdly, we're seeing very compressed and accelerated timelines in transactions. So how do you get ready for that and not create a bunch of risk for yourself in the process? The last item that we want to cover is what should you consider pre-transaction? So what are some of those tax planning items that are important for you to consider oftentimes even before you start some sort of a process? So that's kind of what we're going to cover. Learning objectives, we of course would like you to, kind of understand a little bit of that stuff. So I'm going to start off here with a question just to kind of understand who the audience is today. We've got a number of people out there, and the unfortunate thing in these virtual settings is you don't really get to know who you're speaking with. So 5 different areas that we think describe most of the people that are going to be a part of this, helping us understand what we should maybe cover in a little bit more detail as we move forward. So with that, we've got 355 of 963, lots of people coming in here.
Andy, I'll just say good job of geographic diversity here. Until you said it, I didn't realize that we've got the East Coast, the West Coast, and the Heartland well represented.
Yeah, absolutely. And the great thing is we got Jennifer up early in the morning to join us. Hopefully she's had her cup of coffee and a couple of pieces of Halloween candy before she got on here. So with that, we've got about 849. So we're going to close the polls here shortly and move on to our answers. So in 1, 2, 3. So most of our participants are advisors, which there should be a lot of great information in this for you with, as you can see, a number of people that would describe themselves as others, I think no matter what your role is, there's going to be some great information for you out there. So with that, we'll move on to the next slide here. What's going on in the market? So with that, I'm going to turn it over to Jennifer to talk a little bit about PE deals.
Thanks, Andy, and glad to be here this morning. To really frame the current market, it's a really exciting M&A deal activity time. Private equity buy-side deal activity is having a record year in 2021. There's been about $457 billion worth of deal activity through the first half of the year and about $787 billion worth of deal activity through the first 3 quarters. And this is based on data from PitchBook. And interestingly enough, and exits are even hotter, including it's the most active half year of public offerings as well, which Steve is going to talk about SPACs in a few minutes. So as a reference point, as of the end of the second quarter 2021, exits in 2021 were nearly as great as 2020. And private equity dry powder is to be deployed still remains high. So that's all good news on the deal front. And the other thing we always talk about is multiples, right? So, overall, the median PE buyout ratios of enterprise value to EBITDA through September 30th, 2021, based on PitchBook data, is about roughly, I'd say, 12.5 times, but this can vary greatly by industry and sector. For instance, this probably won't surprise too many people on the call, but tech continues to have the highest multiples with average counts or average multiples of 20 times EBITDA. And once again, according to PitchBook data. And some other items we're seeing affect, deals is demographics as well. And I will turn it over to Steve.
Yeah, thank you, Jennifer. The first thing I'll just mention is that all my comments, those are my opinions, but my experience spans 3 decades, and the full amount of that time it's been observing what's been happening in the markets, and principally the private company markets. That's been my area of focus, and there's been incredible change. And so the question becomes, well, what is the change attributable to? So if I just go back to, the clients that I tend to deal with day in, day out, in 2007, the majority, about 60% of them, wanted to retain operating businesses. They were entrepreneurial. The family was entrepreneurial. They were looking more at wealth transfer and retention of an operating business as opposed to transactional monetization. You fast forward to where we are today, 70% of the clients that we see are transactionally oriented. And, that's a 14-year shift. And I think it reflects kind of a paradigm shift in that I don't see us going back. So then the question becomes, well, what is it? And I tend to think of it as kind of the acceleration of the business life cycle. If you look at 1950, the average lifespan of a S&P 500 company was approximately 60 years. You fast forward today, and it's under 20 years. And I've seen data that indicates that it may go down to low double digits, 12 years. Part of that, I think, is as a result of what we're seeing today, which is kind of these global shocks that have been occurring. Great financial crisis, obviously more recently, the global pandemic. I also think that the disruption as a result of technology, globalization, and I recognize there's been a bit of a retrenchment there with tariffs and pullbacks, but ultimately it's been highly disruptive, and it has increased the volatility for businesses in the market. And the last thing I'll hit, and probably everybody on this webinar has heard this before and said, okay, how many times am I going to hear this? It's the graying of the baby boomers. But I think we're finally there. And if you think about, and Jennifer, you're going to hit more on this, and you have to hit that sweet spot when you monetize your business. It can't be too close to one of those downturns in the market. And you got to leave a little bit of that meat on the bone so that the buyer gets a little bit of upside so they can give you that full valuation that you're talking about. And that's exactly where I think we are right now. And maybe there's a discernment around the next generation and their ability to kind of take over that business. So clearly a demographic shift. I'll shift into kind of the shorter sale process. And again, I know that we're going to kind of go into that with a little more focus, but in my mind, it's not necessarily a trend, but it's a reality of today's market. And that market, really the catalyst for that has been what we have known and anticipated, which is higher tax rate regime as a result of the last federal election. And we've heard that from the White House. We'll talk a little bit more about, Build Back Better bill that impacts that. But a lot of business owners have been targeting getting a deal done by the end of the year, if only to arbitrage what they feared was a rate differential in long-term capital gains. That may have been disrupted a bit by the bill that came out on September 13th. But, if you're moving forward, you need to move forward quickly, but also recognize that you don't want to leave value on the table. I guess what I'm saying is don't let the tax tail wag the dog. So, be smart and informed about that process. I'll turn it over to tax uncertainty and Andy.
Yeah, Steve, I mean, that was a great lead in to what I was going to say. We started out 2021 with kind of a march towards a capital gains rate of, expected 39.6. Then, a couple months later, some studies came out and they said, hey, 28% is that's really the key point where we've maximized federal revenue and haven't hurt the economy. Then we got the proposal from House Ways and Means on September 13th that you were alluding to, brought the rate down to 25%. Now, late last week, they came out and, it would appear that capital gains rate changes kind of aren't on the table, at least for the time being. Who knows where it's going to wind up at. This kind of creates an environment where business owners were sitting there, the beginning of the year, it was kind of like full steam ahead. We've got a huge rate change. We need to get deals done. Kind of started to see things come back a little bit. But I think through the process, what I've seen is I'm not so sure this has driven many decisions that would have been made 5, 6, 7, 8 years down the road. But what it has done is accelerated individuals that were kind of on the cusp of making a decision, right? So what that's done is it's taken, deals that were maybe a year, 2 years out in the future and accelerated them into 2021, hoping that we could capture those lower capital gains rates. So I think this has had some effect, but I think the effect has been minor. I think most of the clients I've talked with, tax uncertainty has been the thing that's kind of tipped them over the edge to do a deal. But really things like higher multiples, demographics, stuff like that really kind of brought the idea to the table. It's the tax uncertainty that was kind of like, well, I'm already at the table. Let's get this deal done. So, but I certainly think it'll be an interesting next couple of weeks as we continue to move forward with some of these legislative decisions. So. With that, I'm going to turn over to, that's kind of my opinion of what I think has had the largest effect on the M&A market. What's your opinion? What do you feel like has kind of driven the current trends in the M&A market? Steve, I'd be interested in what your opinion is here. Do you think it's the aging baby boomers, or do you maybe think it has, the tax rates have had more of an impact than I believe they have?
If you were asked me if we had a bubble at the very bottom that said all of the above, that would be the one I would hit, because I think what I mean? I think it's kind of that perfect climate of recovery, valuations, cash on balance sheets, interest rates, and demographics, and tax drivers. I think all of them are conspiring to create this market. And, something you said, I think bears watching, which is how much pull forward are we going to see of M&A activity that would have normally in the life cycle hit in 2022 or even 2023? There's going to be some. That, I think, is indisputable. How much, I'm not sure. And that the other thing I would caution people is trying to get those deals done. The buyers know what's going on, and they're kind of indifferent to that tax change because they're going to own the asset whether the deal closes at the end of this year or next year. Watch what happens. In 2012, we definitely saw buyers start to drag their feet as a leverage point.
Right. I think that's a really good point. The other thing to keep in mind on the sell side is tax rates aren't static. When changes occur, I mean, if you look back in history, it's kind of an oscillation between a high tax rate and a low tax rate. With capital gains rates, there can be a little bit more time than there is in ordinary rates in that oscillation, but it's certainly not the end. So we've got about 747 people that have submitted their answers so far. Give about 5 seconds here to wrap up your final answer. 1, 2, 3, 4, 5. And we'll move on to, it would appear, we didn't provide probably the best answer, Steve, which you're right, it is all of the above. But it looks like about 31.9% believe beating increases in tax rates has had the most dramatic effect. I could see that. Aging baby boomers comes in second, and higher valuations driving offers third. So, I think that's good insight, and thanks a lot for helping us out understanding what's important to you. That will move on to SPACs, and I'll let Steve, you cover, kind of some of this information.
Yeah, thank you, Andy. I don't know what I was thinking when I offered to talk about SPACs in a lightning round. It could have been the entire substance of the webinar today. But when we talk about SPACs, by the way, special purpose acquisition companies, so it's an acronym, otherwise sometimes referred to as a blank check company. We've seen a tremendous uptick in the number of SPACs over the last couple of years. So to give you a little bit of reference, in 2020, we saw more SPAC activity, successful de-SPACs, which is kind of the industry term for going to, publicly listing an acquired company. It eclipsed all of the prior 10 years in terms of the volume. Where are we in 2021? In the first quarter, we'd already eclipsed all of the SPAC activity in 2020. Now, it's been very volatile, and part of that has become as a result of some SEC kind of first quarter, beginning of second quarter edicts and proclamations. And so they've had a chilling impact on some of the SPAC activity. But SPACs are still going on. They're here to stay. So it's important that we know, what does it mean to the target shareholders, the owners of those businesses get approached by sponsors. So first of all, be ready to move fast. The SPAC speed, as opposed to a traditional IPO or even transaction, it's both an opportunity and a challenge for business owners and their management teams. The first one is kind of a gating threshold question, which is you have to have 2 years of audited financial statements in order to be publicly listed. And these aren't just kind of a normal audited financial statements, but they have to be in accordance with public company audited financial oversight board standards. So typically that's the first thing that businesses that are the targets need to think about. Secondly, it's preparation of what's called a management discussion and analysis presentation. And that's going to include your pro forma projections. And that's one of the unique things about a SPAC is you can give pro forma financial guidance looking forward that you couldn't in a normal IPO. And then lastly, you've got to have really good, sophisticated advisors to help walk you through this because you're coming from a private company to a highly regulated public company. Know what the SPAC sponsors want, in terms of the valuation. Typically, the total enterprise value is going to be something like $1 billion to maybe $3 billion. So it's important that you understand kind of, what's the total value of the business post de-SPAC to see if you're going to be an attractive target. Secondly, what are the sectors? And what we've really seen is SPAC sponsors have focused on what I refer to as the yucks, the young, unprofitable companies, but we're beginning to see a bit of a shift there towards more mature companies that actually do have profits, revenues, and EBITDA. But the sectors tend to be electric vehicle and all of the kind of OEM tier manufacturers of the parts, healthcare, industrials, and then tech and cyber. I mean, all of those are interesting. And then, SPAC sponsors want to know that you've got that deep bench, that you can continue to run the business at the same time that you're dealing with the SPAC process. Thirdly, stoke competition among SPAC sponsors. As there's increased activity, and we think there are more SPAC sponsors out there than really good quality targets, it's important that you kind of run a process where you identify who's the right SPAC sponsor for you. It's kind of in the industry referred to not a bake-off, but a SPAC-off. And traditionally, you want sponsors who have experience. All right, understand why the pipes are key. And again, it's an acronym, private investment in public equity. And if you think about the bank in a traditional deal, that's the PIPE sponsor, the PIPE capital that's coming in to support the SPAC deal. And with the increase, I'm not going to get too technical, but with the increase in redemption of shares, but acquirers holding the warrants associated with the SPAC units, it means that you need a third party to help fund the deal. I mean, right now, I think we're trending towards almost 2/3 of all SPACs are redeeming the shares that are used to acquire the target company. So the PIPE has to step in and fill that void. Lastly, I'm going to say proceed with caution, right? If you're dealing with a SPAC, you should be asking for a reciprocal exclusivity agreement. You don't want them locking you up at the same time that they're still out shopping, so it's a no shop clause. The earnout provisions are going to be key. The SPAC performance that we're seeing today versus a year ago has really dropped off. So post-successful de-SPAC, a year ago, we were seeing like a 25% pop in the publicly listed price. Today, we're seeing something closer to 3%. So make sure you understand what that's going to mean in terms of the lockup provisions. And then just be aware there are costs associated with the SPAC, even if it's unsuccessful, and you'll bear those costs. So, Andy, that's kind of where we are on the SPACs.
Yeah, I think, that last comment is great advice, Steve. Proceed with caution. I think it's always important that before you get into something, you kind of understand exactly how it's going to wind up, what the clauses are. And we'll get to this in a minute, but make sure you have a team that has been through it before so they can kind of warn you and allow you to be proactive. So the next question that we were going to deal with is, how do I accelerate a sale timeline? So the first item that I usually go through with clients is just understanding your personal goals. I had a client that came to me a number of years ago, and they said, "Hey, Andy, I'm thinking about transitioning my business. I want to get the highest valuation I possibly can, and I'd like to talk with you about an ESOP transaction." The issue that you deal with there is you've got two competing goals, right? You've got an ESOP transaction, and you've got that I want to get the highest valuation I possibly can. Those two goals don't usually work together because of the way that an ESOP works, right? Usually you've got a lot of leverage in the deal, and that doesn't always lead to the highest valuation, as well as you don't have that normal process that you're going through where you're playing bidders against each other. So it's important that you understand exactly what's important to you, because that's going to help us as advisors kind of bring to you what's most important, right? Is your family important? Is getting the wealth to the next generation important? What do you need to live off of? All of these things are going to kind of guide the rest of the process and allow us to advise you how we reach those goals and what the potential pitfalls are that you're going to run into very early on. Proactivity is key to an accelerated timeline. So I think that's the first thing that I usually go through with clients is making sure that we understand what their goals are, they understand their goals, but lastly, that those goals all kind of work together, right? And if they don't work together, that we've ferreted out what's most important from the beginning. So an important part of that, of course, is building an M&A team, and I'm going to let Jennifer kind of deal with that if I remember correctly. Or no, I guess it's Steve. I'm sorry.
Yeah, no, I'm prepared to handle that one. But I think it dovetails off of exactly what you said, which is, you start first understanding the personal goals, but you recognize, if you're a business owner or a shareholder in a business, you have both the kind of the corporate balance sheet, and you're trying to optimize success there. And then you have the individual balance sheet, and you want to optimize success there. And the only way you're going to be able to harmonize those is by really making sure you've built out a robust team of advisors. And again, early in my career, I worked with publicly traded companies, and they kind of were willing to throw money at the advisors to try to get the most accretive deal for themselves and their shareholders. But the bulk of my career has been working with private business owners. And so that's, his or her checkbook. And so that business owner, she thinks about it that way. But what we have to be careful about is you need to have the right advisors And I think about advisors like I would any other input in a successful business. You want to get a return on investment. And so that means in the context of a potential sale, making sure that you have good corporate legal counsel. You've got good personal trust and estate legal counsel. You've got good corporate tax advisors, accounting advisors, transaction advisors for things like a quality of earnings study that increasingly we're seeing be required by the sellers, not just the buyers who we know are going to do it. Making sure that you've got, the right team in terms of helping you on the financial investment side. If you're going to go from a highly concentrated illiquid asset to suddenly a more public portfolio investment scenario, you need to know what that's going to look like in advance. And then what are the tax opportunities in terms of harmonizing pre-transaction planning, right? And I know we're going to talk a little bit about that. But that's that whole team. And then do you need a financial intermediary, so an investment bank before going to market? Sometimes the worst deals you can do are you get the inbound and preemptive offer, and you don't do a sanity check with advisors to figure out, is that the right deal that's out there for me in terms of how do I get to my goals that you just talked about, Andy? So with that, I will turn it over to Jennifer.
Jennifer, are you muted?
Oops, thanks, Steve. Sorry. Yeah, I think I'm just going to tack on to what you were saying. Is it's really key to have a great team of advisors that know your industry and know your sector, right? I think when we are approached by clients through a sell side process, the first thing they ask is, "What do you know about your our industry and our sector?" Right, which I think is really key. And as you mentioned as well, this is a wholesale process. I'm an M&A tax partner. I focus on tax, but there's other areas that need due care, right? So financial diligence and the Q of E is a key item to help drive value. Tax, we're focused on what are the deal benefits, what are the deal detriments, how is that going to play out during the deal? Then we have, IT, what type of systems does the company have? What type of systems does a potential buyer think they'll need to have? And how does that impact deal value, right? Cyber's been a hot area for a very, very long time through the deal process. And then, HR, what type of benefit plans, pension plans that are currently in place that could impact, the buyer in post-close. And really, preparing for all these things, sooner the better can really, help through this process and a lot of different ways to think about things through the deal process as these items come up, and then ultimately how it impacts value and, what Andy's going to talk about next, how it's going to affect the modeling and the after-tax proceeds.
Right. So everything that we've talked about so far, and I really think this is the key to acceleration, is based upon proactivity, right? It's the ability to kind of predict what are the areas that you're going to need to spend time on, and make sure that you understand what the outcome is going to be. And a decent model is kind of key to that. I remember, just a couple of years ago dealing with a client that they knew the number that they wanted for their business, but they never were willing to spend the time in order to really model out what that number meant to them. So they sat down, they went through the deal process, they got the number that they wanted, and then they came back and they said, hey, now we need to figure out how much we're going to have after tax. And they were surprised. They had a lot of leverage in the deal. They'd grown the company dramatically, but they'd done it through debt, and wound up getting about 50% of what they actually wanted on an after-tax basis. This also can allow us, on the front end to sit down and say, okay, what happens if we have to give a little bit on price? Create those parameters so that we know after tax what gives us what we want, and what should we really be shooting for, right? Where should we be willing to give in the negotiation, and where should we be willing to stand strong? All of those things can really be based upon a model, but it also allows us, as we get into the process, to be able to take different parameters that the buyer has given us and run them through the model very quickly so that we can respond to different changes, right? One of the worst things that can happen, well, there's many bad things that can happen in a deal, but one of the worst things is a buyer throws something at you that you're not expecting, and it takes you weeks to respond because you have to build your model from scratch and be able to understand exactly how that's going to affect things after tax. That's why one of the big things that I always recommend is let's build a robust model on the front end. Let's make it dynamic so that we can make changes to it and we can be able to respond on the fly to what those different levers are that you're going to wind up pulling. So with that, another item of proactivity, understanding what the deal levers are, right, Jennifer?
Yeah, and I
can't just model them out.
Yeah, no, and the interesting thing I would say is we talk and we do these models earlier and earlier in the process, right? There's kind of a cycle to the models, right? We take and we have this basic model, and I think that's really, up front when you're understanding your personal goals, like, hey, what's the big swag? What's the big picture? Where do the owners want to see after-tax proceeds be? Like just at a basic, right? Because I recently, because of your point, Andy, where oh, well, we thought we had EV, enterprise value of this, but oh, we forgot about our debt or our debt, other debt-like items that takes the value down to the owners. And you kind of have to set the stage from the beginning. And no deal is perfect. Nobody's going to go through a diligence cycle with nothing coming up, right? But the key is really being the most prepared you can be. But typically when we're doing these models, as the deal progresses, we're starting in the beginning with all the inputs we want, all the inputs we know as working with the sellers and the company. What do we think is going to happen? And then as we get bids in, if we have multiple offers, running those offers through the models and figuring out how the different deal values and other aspects of the deal may impact after-tax proceeds. And then we're getting through the deal process when we come down to deal levers. And this is where, certain things the buyer is focused on may be a detriment or a benefit to the deal process and the modeling and the after-tax proceeds. But really what we're trying to understand, and this is comprehensive. This is just not, tax items. This is the overall deal process because one deal lever could impact another deal lever. And, I have clients, I'm an M&A tax partner, and they're like, Jen, this is an overall process, just not a tax process. So, it's really key to work and have a great advisor team that's close knit because you're going to share that information and really come out to the best outcome. But, really from a deal lever perspective, from what I see from an M&A tax perspective, it's really the items we're trying to build in and to highlight are really one of the biggest one is, tax deductible step up to the buyer. What's that benefit? If there's a cost to the seller, what's that cost and how can we increase, proceeds? A big issue always comes up most deals is sales taxes, right? And what's your deal lever? Are you willing to enter a VDA? Have you already entered a VDA? What's the exposure? How far along are you in the process? And I have many clients that say, well, we have this exposure, but we also have these benefits because they prepared. They're like, well, we might have these sales tax benefits, but by the way, I'm a C Corp and I can give to you federal and state NOLs and tax credits, present value of time of those items that offsets that exposure. And where you come in these negotiations, it just depends. Maybe you it's a win-win for you. Maybe it's a compromise. But the key is if you understand and you're planning ahead and you're working on the model, and the model is as every deal lever kind of comes in play, you're plugging it in. You have a really good real-time picture of what the impact of certain items that are going on in the transaction. So I can't say enough about planning ahead and about modeling, but also just really, building that really key team of trusted advisors that really know your space and also that are really familiar with deals. I think that's really, really important through the sale process.
Yeah, I think that's great advice, Jennifer. And, one of the big things here is this all takes time, right? One of the worst things that you can do is just take that original offer and just run with it. It takes time to develop the team, build the model, understand your goals. Sell side diligence is extremely important. I always tell clients, you don't want to be surprised when buy-side diligence comes in, because then you're having to think on your feet. So great advice. With that, we'll move on to our next polling question. Are you prepared for an offer? So, we've got a number of, there's probably a ton of different answers up here that aren't even listed. But, at the end of the day, Jennifer, let's say I am that client that isn't prepared for an offer, but somebody sends me a fax and tells me I'm willing to offer you $1 billion for your business, and I just don't think I can turn that down. What is the most important thing do you believe to focus on when you're in that scenario? If I can only hit on one of those topics, what do you think is the most important?
Oh boy, that's
It's not really fair because all 5 of them are
It's not a fair
right?
question because number one, it sounds like it's already a good offer, so I have to eliminate, right? I think to build the best team, right? Build the best team that knows your industry, your sector, and that works in that deal size, right? Because smaller deals may move, smaller middle market deals may move at a different pace and swag than larger middle market deals, right? So I think it's really getting the right advisors, because the right advisors, like if you told me your industry and you told me your sector, and I think Steve could probably say the same thing, we could probably guess what your issues are going to be before we even started diligence, right? Because there's certain industry issues that come up in diligence, right? Personally, I would, get a great team of advisors quick, right? And then also just have, conversations with all the different advisors, and you're not going to have the time to do everything. And that's the other part of the deal. You really need to focus on the items that are going to influence value, right? So maybe you have a really good tax bill of health, so that's not the issue, but you have some, HR issues, or you have some, softness in a couple QV numbers, right? So you have to choose kind of where you're going to spend your time.
Right. I think that's great advice. So with that, I'm going to close the polls here. And it looks like many people are unsure, almost 50%. Maybe, but we need to consider more preparation. I'd kind of expect that, to tell you the truth. It's a scary process. And until you kind of hit that point where you've got the right advisor or the right team of advisors, it's hard to say whether or not you're ready or not ready. So with that, we're going to move on to what exactly are the top 5 things that I need to consider pre-transaction. And I'm going to let Steve, you kind of cover estate and charitable planning.
Yeah, no, I'm happy to. And before we leave the last topic, I know we got a question in from one of our participants. For a company that has grown through acquisition, does it matter for a buyer if your legal entities have not been consolidated? And I think the short and simple answer is it could very well matter. And so there's a lot of different ways you can think about consolidating, but depending on who that buyer is, they may not actually be a qualified buyer of your existing entity. So I do think that, that kind of fits with what Jennifer was saying in terms of get with your advisors and start to think not just from the lens of you as the operator of the business, but also the lens of a prospective buyer. What's going to make this cleaner, easier, more tax accretive, because then you can ask to share in that value. So sorry for digressing for a minute, Andy, but so, when we think about estate and charitable planning, the one thing I want to leave with everybody, because I know we're going to be short on time here, is, be aware of kind of what's under the microscope right now as it relates to potential tax change and in the proposed kind of Build Back Better law that was issued by the House Ways and Means Committee on September 13th. And if I just cherry pick like some of the big issues, it's probably going to be lifetime exclusion, which is going to have, in terms of, going from today, it's at 11.7 million per individual, 23.4 million for a married couple. That was already scheduled to sunset as a result of the 2017 Tax Cut and Jobs Act, but that wasn't going to happen until the end of 2025. That very real possibility that gets pulled forward to the beginning of 2022. So it's imperative that people put that to work, that exclusion, or else they're going to lose that opportunity if the bill gets passed. And I know there's some question about that. some fundamental changes to, kind of traditional irrevocable grantor trusts and how they'll be treated in terms of exclusion from your estate or potentially being pulled back into your estate under proposed calculations under the Build Back Better bill. And then the same thing as it relates to the potential to trigger income tax treatment upon disposition from a grantor to an irrevocable grantor trust. Today, that wouldn't happen typically, but under the new bill, it very well could be triggered. And some of the most accretive planning techniques that you see out there by planning professionals could be impacted. So grantor retained annuity trust, spousal limited access trust, irrevocable life insurance trust, all of those may look very differently from a planning perspective next year, depending on what we see. And then the last thing I'll say before moving on to Jennifer is valuation discounts. I mean, the valuation discounts have been under the gun by the Internal Revenue Service for years, if not decades. But for the most part, they have survived. And this is another shot across the bow, which would limit or disqualify discounts in any passively held minority interest in an illiquid equity position, which is oftentimes thought of as family limited partnerships or family limited liability companies. So it's really important that business owners get their planning done by the end of the year, because I think there are some legitimate concerns that the horizon, the landscape will change next year.
Yeah, so if we continue on, and another item is the in pre-transaction, right? I think the estate and charitable planning though is really key, because in my personal experience, sometimes that can take time in family settings, and so key, and some of it is time sensitive as well. So I think Steve's comments are very, very important. But then if we move on to pre-transaction reorganizations and structures, this is sometimes it's very simple and sometimes it can be extremely complex. And, and once again, time sometimes is not our friend. A lot of issues we see is if you have two businesses that are combined and you only want to sell one business, or you have multiple owners and, or a family, and half the family wants to keep one business, half the family wants to keep the other business. You're selling one business, you're retaining one business, and you want to do this in a tax efficient manner. And sometimes those items, they just take time, right? And they also take, extra tax planning and data to make the decisions, right? So sometimes you need to do, complex tax basis studies or earnings and profits and studies. You may need to obtain third-party valuations or consult with other advisors, such as, regulatory advisors. Go back to modeling. You may need to model different scenarios. So breaking up businesses and selling one or the other in family dynamics, or even in just an overall owner dynamics, can be complex. The other item we see, considering a transaction, I've been in several conversations where, especially when tax rates went down, a lot of S corps can, wanting to change to C corps. But if you're thinking about going through a sale process in the near term, buyers love to buy S corps, especially if they can get a tax deductible step up, which, if you're working with an investment banker or your advisors, they're going to say, hey, we want to increase our purchase price because we're delivering, a tax deductible buyer or tax deductible step up to you buyer. So you want to be, consult your advisors. You really want to think through about, how does that impact you currently? And how would whatever you're considering impact a buyer? And then you always have to think, too, because I've seen, we think all deals go through, they don't. And you may start a sale process and you may say, well, we don't want to continue on that process for some reason, that you kind of have to have that plan, too, to say, well, if we do X, Y, or Z, how will that impact our overall goals and plans if a deal potentially didn't go through? So I think there's a lot of things to consider on the pre-transaction reorganizations and structure. And some of the items, you just need more time to to do them more tax effectively. And Steve, I don't know, or Andy, if you have any other comments on that part.
Yeah, I mean, look, I think it's well said, and and it kind of fits into the question that we had, which was, how should I be thinking about the the entity status and the reorg, and I think part of that's just trying to anticipate who's my buyer, my most likely buyer, and how are they going to be qualified or classified, and what does it mean from an acquisition perspective, and then who owns or loses the tax benefit. Depending on what happens in terms of, gross up of assets, step up in basis. So all those are really important. And I think, the one very consistent theme is if you're a seller, it's almost too late if you wait for somebody to come knock on your door. You really need to be kind of putting together all of the diligence around your financials and your tax position well in advance of the transaction.
Right. I absolutely agree, Steve. And it's kind of where everything that we've talked about so far fits together, right? Understanding what your goals are, thinking about where might I head, but thinking about it very early on. I have clients that are forming their business today. And one of the things that they're thinking about as they form their business is who's going to buy it, right? Getting back to your discussion about how the life cycle of a business has shortened over the years. So I think all these things kind of play together. But, what I wanted to kind of chat about here is just state and local tax planning. There's a number of different topics to think about here. No presentation on preparing for an M&A deal would be complete without talking about residency planning. It's important to realize that it takes time in order to establish a residency, right? It's not something that you can make a decision on the eve of a deal that you're going to move to Florida so you can avoid state income taxation. It takes time. You probably also have to do more than just rent an apartment in the location of your choosing. But one of the largest pieces of advice that I give clients when they're thinking about residency planning is make sure it's where you want to live. At the end of the day, many clients that are going through this sort of process are going to have plenty of money to live out the rest of their lives. Their children are going to be very well set off. Maybe once we get to grandchildren, it might start to be a little bit different. But all of that can be ruined by making a choice to live in a jurisdiction where you're not going to be happy just so you can save some tax dollars. The other thing that people need to think about is something that's a little bit newer, the pass-through entity tax election. So this is an election to pay tax at the entity level. And the IRS has kind of come out and said, hey, for the most part, we can have deductibility of these taxes in a business scenario. So it can kind of make a huge difference in some sort of a deal structure where instead of being subject to a $10,000 cap on itemized deductions, you may be able to get the entire amount of the benefit as a deduction, giving you essentially maybe a 20% discount on your state and local taxes if they're offsetting capital gain income, 37% if it's offsetting ordinary income. The last thing I wanted to kind of get to is just modeling. Make sure you understand what your state tax footprint, what effect that's going to have on after-tax cash. I remember a client that I was working with a number of years ago that had to go back to his shareholders and ask for money back because of withholding taxes and composite taxes at the entity level. It's not a fun scenario to be in. And in the changing environment that we're in regarding just nexus and what constitutes nexus, it's important that you take those things into account and maybe overestimate the amount of taxes that you're going to have. Because I'll tell you, most shareholders that I've dealt with are a lot happier getting more money in their pocket after the tax return's filed than they are having to cough up money back to the organization. So with that, I'm going to turn it over to Jennifer to talk a little bit about tax benefits and exposures.
Thanks, Andy. And the one thing I'd like to say, too, a little bit about the state and local is that even though if you move to a non-tax jurisdiction, that doesn't necessarily mean you're still not going to pay state income tax. I worked on a deal recently where several owners moved to Florida and a couple other non-tax states, but they were selling basically a deemed asset sale for tax purposes, and that gain can be apportioned to many states. So even though a majority of where their business was in a non-income tax jurisdiction, there's still apportionment potentially of gain to other states, and that kind of goes into that pre-transaction reorganization and structure. If you're working with your advisors up front and doing that planning, you can get that all modeled in, like Andy said, and then that new state tax workaround is really in fact impacting our modeling as well from a sell side perspective. But really, through the whole sell side process, right, the whole key is really to understand the tax benefits and exposures affecting value. I know we're running a little bit short on time here, so I'll go a bit quick, but really I'll just hit on some of the top items. Andy already hit on nexus is always a key, right? Nexus, where a company is filing taxes for both income tax as well as sales tax. For S Corps and partnerships, delivering that tax deductible step up and providing a plug and play, which we call it, to potential buyers for them to estimate the PV value of a tax deductible step up is really pretty much common fare now in transactions. So that's, a typical part of the sale process right now. For S Corps as well, goes into the modeling, the state nexus stuff we just talked about is the tax gross up, right? For an S Corp owner that sells, there could be additional tax cost, and it is common practice to potentially ask for a tax gross up from a potential buyer to make you whole as if you had sold basically C Corp stock. And, that could be a negotiation. A buyer may cover all of that cost, part of the cost, but, you need to know what that cost is going in to be able to negotiate additional purchase price. For C Corps, understanding tax attributes that a potential buyer can benefit from post-close and the PV of those items, such as net operating losses, tax credits from both the federal and state perspective, and even an international perspective, that's key. Some items where we see that aren't so good, that can maybe lead to escrows and holdbacks. I think the number one that I typically see, my personal opinion, is sales tax. And then, bad S corporation elections, bad check the box elections. If those items come into play, you need to figure out how to remediate them, or if you do an escrow or holdback, or how those items work out. Some other areas, independent contractor issues. In certain industries, those items are key because those are EBITDA items, right? Some adjustments on independent contractors to make employees could affect EBITDA and the overall, deal value. Could also lead to escrows and holdbacks. This is kind of basic, but lack of support for tax reporting positions. You can't find elections, statements, there's been change in owners, tax providers, things like that could lead to holdbacks and escrows. You can't support that you have NOLs and credits. You don't have the work papers. Those are items that could lead to escrows and holdbacks in certain situations. Transfer pricing between related entities, that comes up, especially in cross-border. It can come up in the domestic situation as well if you're selling maybe a C Corp and a flow-through entity together. And we hit on this a little bit earlier too, is if you're trying to carve out businesses, retain one, sell one, you could have tax cost of carve-outs. So there's really, a lot of items that could potentially come up in diligence, but I think through the planning and working with your advisors, you can figure out which of the items that could have the most impact on your deal. And, and the thing is, the deals aren't perfect, right? Things are going to come up, but I think having the plan, at least you can put yourself in the best position to deal with a buyer and to maintain value. So I think we have only a couple minutes left. So I'll just do the last topic and then we'll go to our final poll and wrap up. But the last topic, and I'll just go real quick here, is, international tax planning and consideration. I would just say don't don't forget about any non-U.S. operations, especially if they're not that significant, because sometimes we see bigger issues with smaller operations, because maybe there's not been a lot of attention paid to them, or the operations, have had some turnover, or there's been some significant growth. But the key is on the non-U.S. side, if you get the right advisors, M&A international tax advisors involved, they're going to know the issues that a potential buyer is going to look at. Very simply, looking at the filings, the registrations, the audits, making sure everything's in order. Buyers are concerned with cross-border intercompanies and cash, and the cost to maybe repatriate those back to the U.S. So, getting with some good M&A tax international advisors, they can assist with that. There's transfer taxes, indirect transfer taxes, stamp duty taxes related to the sales in certain countries. To have an understanding of those is really key as well. And then there could also be U.S. impacts of selling a non-U.S. operations that really, getting a good ITax M&A advisor involved they'll be able to help you work through those items.
Right.
But with that, I will turn it back over to Andy.
Yeah, I think those international tax issues are extremely important. So with that, we'll come to our last polling question here. Before our transaction, I'm most likely to consider, and we've got a number of different planning opportunities here, as well as, we've scared you so much that you might just continue to own the business going forward. So, as I think about this, one of the most important things pre-transaction is that you don't just pay attention to the business. It can be such an important and time-consuming time in a business owner's life that they oftentimes lose track of things from an individual perspective. Those aspects of estate and charitable planning. It's the last time that you really get a cut at the apple to offset ordinary income with charitable contributions, because most of your income going forward, unless you own another business, is likely going to be capital gain and qualified dividends. State and local taxes can have a huge drag on after-tax cash in a transaction. If there's a way you can avoid it or mitigate it, it's important to keep those in mind. So, I always try and impress upon my clients, be sure that you keep both of them in mind, and realize that, the deal is going to consume your life. So you kind of have to do it early if you're going to do it right. So with that, we've got 729 of our participants have answered. We'll give about 5 more seconds for folks to get their final answer in. And it seems like things have leveled out quite a bit. So we'll move on here. It looks like we only scared 8.5% of the participants. So that's pretty good. I'm excited about that. Most people are feeling like they need to get a better handle on their tax benefits. I think that's absolutely true. That sell-side due diligence and kind of doing that work ahead of time is extremely important. With structuring and charitable planning and estate planning kind of following the lead, with considering moving to another state kind of being one of our last things to consider. That's kind of my experience in working with clients too. So it doesn't surprise me as far as the answer. With that, we'll kind of pull it to an end here with one final polling question. But lastly, I want to thank you guys for your time. I want to also especially thank Steve Faulkner for joining us from JP Morgan. It's always great to work with Steve and present with him. Very knowledgeable professional, as well as Jennifer. So thank everybody for your time. Hopefully we've given you a couple things to think about in an M&A transaction, and hope you enjoy the rest of the summit. So with that, I'll turn it over to Allison.
Thank you so much, Andy, and thank you so much to Jennifer and Stephen for joining us and our audience for the second session in Tax Summit. A couple of reminders before we conclude. Please take a moment to participate in the attendee survey by following the link in the resources list to the right of your screen. You can also click the link to return to the Tax Summit lobby as well during any time. If you have met all CPE criteria, you may download a copy of your certificate by visiting the Certification Center and clicking the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude our event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. Thank you so much for joining us, and again, take part in all of the events that we have throughout Virtual Tax Summit Week, and we invite you to participate in the Game Center as well with Jeopardy and a scavenger hunt throughout the week. Thank you so much for joining us, and we look forward to participating in our next Tax Summit event. Have a great day.